India Bonds presents CNBC TV 18, India's Fixed Income Summit.
I found the topic actually very, very interesting. Building balanced portfolios with fixed income. When people think about fixed income, they always wonder whether or not it's just a defensive strategy and they don't look at it as a value creation strategy. So let me start off with you, Santosh. What do you make of that perception problem as of now? I see a lot of push with regard to equities and various other asset classes, but this seems to be a little bit the push seems to be lacking. What do you have to say about that?
Yeah, but I think you coming on the fixed income panel is a big thing for me. So I'm sure the times are changing a bit. So I frankly think that I don't think there's a problem with the fixed income. I think there's more of a problem on perception of the equity side. Equity side, not fixed income. Fixed income is doing what it's supposed to do. But somehow this feeling of equity at all points of time, anytime you invest, you make fantastic wealth creation, is India's decade and India's century. I think that is something I think which is wrong. Fixed income is doing what it's supposed to do. People should realize that at all points of time, if you keep investing, you won't make decent returns. So time like this, when the last couple of years, the returns are a bit negative, that's the time I think it comes out in open. So we have a credit fund which I've been promoting over the last couple of years. And the first few years, the view was that 4 years, you are joking, fixed income, equity is supposed to get you 20%. And I said, who told you that? He said, CNBC told me yes. Right? So not CNBC, but I'm saying at any point of time you invest in 5 years, you make 20%. I think that is somehow slowly changing. Still a significant part of the investors who are coming in the market over the last couple of years, just to give some data, I think in mutual fund, we have 6 crores unique investors. Guess 2020, there were only 2 crores. Okay. So from 1964, US 64 till 2020, we had 2 crores investors, which became 6 in the last 4 years. And therefore, these 4 crores investors never seen a down cycle. I think they still can't believe that the returns can be low. I think over a period of time, I think slowly we'll see more appreciation for the fixed income side.
Okay, all right, interesting. And sir, just to tell you about my personal investment, there is a proportion of my investments that goes into tension-free, risk-free, and hopefully my kids are happy someday.
Aditi, I'm telling you, please record this. Keep showing this on CNBC from tomorrow.
Okay, all right. Harini, let me come across to you. This digital push, that's something that could attract a lot of the youth, the younger folk. At times, when you go for a drink on a Friday evening with the younger folk, if you talk about some of this fixed income, the gradual returns, they'll be like, no, we are used to the 15-20%. At least that was what we were hearing a couple of years ago till this equity market started getting a little dicey. How important do you think is the digital push? And if you could come in with a comment even on the taxation aspect.
Nigel, see, the way I see it, equities have been culturally mainstream in India. Much longer before and much longer and much faster than fixed income, right? So, see, finally, both, whether it is equity product or a debt product, both are a set of discounted cash flows. But having said that, equities are very relatable, more emotionally compelling. Whereas fixed income, finally, when you see, you need to understand so many technicalities, right? More nuanced. So you have to know your credit risk, you need to know duration strategies versus accrual strategies. And we're not even talking about ISINs now. Somebody remarked earlier in one of the panels that in equity you have one ticker, right? In bonds you have hundreds. Right? How do you even make sense out of it? Correct? And there's reissuance, and there are so many things to be understood. So I think the learning curve itself does delay adoption. So this thing that you're talking about, I think there's a learning curve to be solved for. And of course, most of the speakers remarked about it. And then there is this whole behavioral element, right? So these Friday evening, drinks that you're talking about, I'm sure people are swapping multi-bagger ideas. They're not really swapping screenshots of balance, bond portfolios, correct? So this whole emotional connect. And whereas, what fixed income really brings on the table is predictability and stability and protection. And these are things that you appreciate over a period of time once you have seen some cycles, maybe older, wiser, or maybe more mature. So I think the learning curve itself does delay adoption. So this thing that you're talking about, I think there's a learning curve to be solved for. And of course, most of the speakers remarked about it. And then there is this whole behavioral element, right? So these things that you're talking about, I think there's a learning curve to be solved for. And then there is this whole behavioral element, right? So this thing that you're talking about, I think there's a learning curve to be solved for. And of course, most of the speakers remarked about it. kind of thing, right? So I think, and the other thing that you talked about is how sensitive is it to taxation? I think extremely sensitive, right? Equities, when you're looking at a 12 to 18%, then the tax is kind of psychologically consumed in the wealth creation journey. Right? That's not the case for fixed income. When you're looking at when you're staring at a 6 to 8%, every change influences your outcome over a period of time. And so we've also seen historically that between fixed income strategies, fixed income products, one over the other they are extremely tax sensitive. So that's another area. So I think the whole tech as well as the regulatory initiatives have taken this a long way. There is no denial of that. But the next stage of evolution for this market needs to come from investor education. And maybe, to take that step forward, like, the youth today, they'll have to be taught a little differently. So maybe we're looking at some biased-sized educational videos. We're looking at memes and maybe some simulated portfolios, right? Maybe gamify the bond maths. Okay. So there are things that you may have to think differently, like Mr. Mittal also said, right? If we need to reach Bharat, if we need to reach the youth, I think we're talking about a different approach.
Okay. All right. Vikas, let me get you into the discussion as well. Household savings, if you look at the fixed part of the portfolio, a common man would say it's more fixed deposits, but there's so much more, right? What is your take on that? Have you seen a bit of a shift on that front from the fixed income portfolio? A little bit of move away from fixed deposits into other instruments?
Thanks for having me here. So I'll possibly try answering in two parts. One is structural, right? So we all know, right, that 60% of the household balance sheet was parked at fixed deposits, right? And then the savers moving to investors. That structural change, I think that's a tailwind that will continue with India, correct? So that meltdown from the fixed deposit balance sheet, right, of a household, that meltdown from the fixed deposit is going to continue, correct? The second part, I would typically say, is, right, that in a fixed income, there is, we've spoken a lot about tax, I'm not going to get on to that, but there is a magical number. The more you move towards the 7% post-tax, 8% post-tax, people are happy to trade off the liquidity for it. The more we are 4-5% of post-tax, then people will need liquidity for that product. I'm only speaking about the debt. Now, this similar psychology will play out at the household level. Right now, it's risk on, risk off, right? So, we've seen a good period of risk on, and that's what Santosh was saying. Now, there is actually a period of risk off, and they're going to really see, right, what the debt product is going to make for me, inflation beating return. So the trade-off is liquidity versus the post-tax return. Point that I'm trying to make is, if the industry, the larger wallet share is going to come in with a more patient debt capital towards the 6, 7, 8% post-tax. Else, any other debt product has to be liquid. Now, if you see the journey from the meltdown which happened from the fixed deposit, I think mutual funds were one of the biggest gainer till like 23, purely because there was a tax arbitrage, right? And you were near to that, it's 7-8% because there's 5% inflation, add up 2-3% to it. That's the magical number, right? And the mutual funds kind of, obviously, a lot of it moved into the SIP, correct? And I today feel the bond, OBPs, right, are offering that piece, which is the post-tax of about 7-8%. Pick up a 10% bond, shave off for the average retail about 20-odd%, it's still 8%. 11%, we shave off 25%, right? It's still post-tax of 7 to 8%. So I think this OBP platform, right, which bought in this product directly, the sweet spot of that 10-11% is attracting. Eventually, we will have to start attracting the larger patient debt capital, which will, to my mind, eventually people will realize, right, that a 5% post-tax doesn't make sense. It has to be only a liquidity product.
Okay, got it. All right. Gopalji, let me come across to you. There is this notion that equity is the way to go. If I want to get rich, I'll put in a lot of money into equity. and some portfolios, they tilt too much into the equity side of things. Do you think some part of the investing community is actually ignoring that concentration risk, so-called concentration risk? Because we know that equity basically has given no returns in the last 18 to 24 months. It hurts a little bit, but yeah, that's the truth.
So I've seen this over and over again. I've been investing for 35 years in India. And personally, I've been investing now for 42 years. So you see a period of slowdown in equity markets. And first of all, it's not about equities versus fixed income, right? It's equities and
asset
right?
allocation. Yeah.
For any long-term investor, we are not, there's a what's driving savings is increasing longevity, right? The average human being is living longer than their productive age. If you go back 125 years, life expectancy on this planet was 32. It's 75 today. If you go back 100 years, even 50 years, the average person was not working for, was almost, I'm sorry to say, was dying on the job. And today the average person lives far beyond their productive age. So balance and consistency is fundamental to a saving strategy. Thanks to what's happening in alternatives, the lines are blurring. So earlier fixed income was fixed income, equities was equities. But, as many speakers have said earlier, there are some wonderful, exciting developments in fixed income that are blurring the lines between fixed income and equities. And we can talk more about this. But two areas are, first of all, listed investment trusts, and the second is private credit. And we can talk more about this, that both these classes of products, which are growing much faster than the broader fixed income landscape, combine features of fixed income and equities, and therefore offer new avenues for investors to capture features of both fixed income and equities, balance their portfolio, pursue long-term investment strategies. So I don't think it's that question, that is passé. Is it fixed income or equities? The interesting thing is that there are more avenues. There are some exciting developments happening in fixed income, especially at the alternative end, which combine features of both fixed income and equities.
Okay, got that. Santosh, coming back to you then. Now I'm a little nervous now because you're viewing me as an equity person.
You're treating me as a fixed income person. I'm not.
But tell me, in your interactions with various customers, clientele as well, and the investor community as well, what is the feedback that you have been getting, and how have you been seeing things evolving, particularly in a period where the so-called equity investor has actually been a little bit under pressure, no returns on the portfolio? So your interactions, in the last 18, 24 months or so.
I think a significant. So firstly, it's not as equity against debt. He said that it's equity and debt. At the same point of time, it's wrong to conceive that all points of time equity can make returns. That's the limited point I was making. India is a fantastic 4 trillion economy, 5,000-6,000 listed companies. I'm sure there are enough opportunities for someone who's expert in equity to make money.
Right.
And I have many friends who have made tons of money and will keep making money because it's a bottoms-up market and every point of time you can find options. But for a normal, simple investor, to believe that at all points of time you keep investing and making a lot of money, that is the misconception.
Indeed.
Yeah. So I think it's just changing a bit, but it's not. Till now, I think the belief is that, earlier when I joined the industry in mutual fund, it was way back in 93, whenever the equity market used to fall, there used to be 10 calls coming up from investors saying that, what's happening? Can I speak to the fund manager? For the last couple of years, the day the market falls, you get more inflows, right? And we proudly say that, wow, see, more inflows are coming up. But to blindly put money when market falls, I think it's not the best thing to do. And we have seen what happened to gold the last couple of months, 25% down, silver 30% down, Bitcoin 30% down, and gold, silver was supposed to be quote unquote safe assets. It was safe asset till the time you were putting money to buy physical gold. After ETFs coming in, it's not investment. It's like you're speculating on gold, you're speculating on silver. So I think a bit of that is coming up, but I think it will take a while, maybe one more year. So last 3 years, I think SIP returns are not negative. Maybe 4-5 years, if it's negative, then I think seriously they will say a post-tax of 8-9%. I think it's a fantastic, and 8-9% is phenomenally good. Only thing our currency may depreciate, and therefore in US dollar term it will look low. And one last point on that fixed income and on the equity risk, what market is not anticipating. A Japanese 30-year at 4%. A US 30-year at 5%.
Yes.
I think, if I recall correct, it was pre-global financial crisis, 2007. US 30-year was 5%. And guess what was the Fed fund at that point of time? 5.25. And when the global financials hit, they start cutting rates. Today, you're sitting at 3.75. And it's upward sloping curve. At that point of time, it's an inverted curve. Your Fed fund was for 5.25 and 30-year G-Sec was 5. Today's 3.75 and 5 is again a steep curve. Japanese 30-year was issued, I think first time issued in 1999. From that date till date, Japanese yen has never seen a 30-year at 4%. And market is saying, forget about all that. The truth is happening, let's go buy more of equity. So I think macro fundamentals, a few things are changing. And I think it will be a testing time for the next 1 year when people will appreciate the 8 to 9% of fixed income tax-free returns.
Valid point. Harini, coming across to you then, in terms of allocation strategy, what would your view be at this juncture? With the kind of yields that we're seeing globally, as Santosh said that we are seeing rising yields globally, and yet, people are still not too concerned as of now, but it could be providing an opportunity in itself. So comment on that.
I think, Nigel, asset allocation, there are a lot of textbook prescriptions, right? So, but I don't think any of that really works in the current context. And as we go along, it works lesser and lesser, really. Santosh made this point today about how we are seeing US yields behave, how we've seen Japanese yields behave. Who would have thought? Most of us come from we all our life, working life, we've seen a very different regime. Correct. Similarly, we've seen very different cycles in the real estate segment. We've seen different cycles in the precious metal segment. Now, if you see, a basic risk diversification strategy, even for a retail investor, would be that you have to have some overseas investments in your portfolio, right? So precious metals, overseas investments, and another thing is, a typical average, since we're talking about wealth management here, so a typical average Indian household, a lot of their net worth is primarily tied up in a single illiquid residential property, which is for consumption. So, right, and in terms of life stage, the allocable, the additional investment avenues coming much later in your life cycle. So, I think we're talking about no one prescription, right? We're saying that the most sensible thing to do today and going forward would be to have enough allocation, enough diversification, and to look at fixed income, say, as not as a low-yielding, diversification of your portfolio, rather than something that enables you to make your other asset avenues work in the long term, right? Because that gives you the safety bucket, which makes you capable of holding out your equity or holding out your real estate or whatever else it is that you've invested in. So I think that's the way to look at fixed income today.
Okay, all right. Vikas, coming across to you, in terms of credit quality, duration risk as well, do you think enough attention is being given by investors today, on that front? And what more can be done, in terms of making the investors more aware of, the various avenues of the market?
Okay. So, I think, they're going to take time, right? Essentially, the current market is a little more yield-focused market. Correct. Good part, and we've seen some earlier panels, right? At least the credit hygiene, the credit quality of the corporates and the financial services seems to be good at this point of time. What it gives the confidence that they are possibly can absorb a little more higher risk. How it pans up, we all don't know. At least I don't know how it's going to pan out. But are they capable to absorb? I think I feel right that they will have a capability to absorb. Now it eventually then boils down to a right structuring. Correct.
Right.
Yes, I think the entities which are facing the retail, which are selling the bonds, have to be a lot more mindful of what is the credit they're taking to the market. Correct. Expecting this from the retail, I think it's too immature at this point of time. So it has to be the other way. Right? It is if whoever is facing the retail and taking those bonds, right, have to be a lot more mindful of what credits are they taking into the retail. That's one, correct? Today, if I only speak about the retail, I don't think so. They understand too much of duration, because a large part of money typically still going in high yield, which is in any case about 2 to 4 year kind of papers. Correct. So they are looking at more like an income generating hold to maturity asset. Correct. So they've yet not seen the duration impact, very frankly, right? Because a lot of the bonds did have a yield compression as well, and that's factually right. Last 1.5 year, right? It's like structurally equity never saw downside, right? Yield compressions have already happened, correct? So one, to answer, at least the retail, if I only speak about the retail, it is more on the industry, correct? For being mindful of the credit. Duration, I don't think so it's too high a risk, because there's still a hold to maturity mindset which is coming in, because eventually they're coming in for the yield, correct? But you see this in the private credit, right? That's happening in a big way, right? The credit funds have tanked up a good amount of money over the last 2-3 years, and that's all patient capital which is coming in, right? So that means they know it's locked in, right? And the AUM is going up, right? So the mass affluent, I think they understand it better, correct? And that's why we see the credit funds typically picking up from the AUM. Retail, I think I'll put it more on the industry, the entire ecosystem, that they will have to be mindful of what they take to the credit retail.
Got it. I think we have a short chat, but Gopal, you had mentioned at the start of the chat that it's both, right? It's debt and equity. So given the challenges, given the opportunities as well as of today, if you had to put into various buckets, what would the asset allocation strategy be as of today? A very, very rough number.
Well, I don't think you can give a generic asset allocation strategy for anyone, but the good news is, again, like I said, the lines are getting blurred. Let's take a step back. The average person who retires today sees a drop in their quality of life at retirement, right? You move from downtown to uptown, or you move from a tier 1 town to tier 2 town, or move from a larger car to smaller car, from X number of bedrooms to X minus 1 number of bedrooms. If you want to prevent that, you need equity-like returns in your portfolio. And thanks to what's happening in fixed income, equity-like returns are now possible in fixed income portfolios. We've seen that over and over again from speakers today. We've heard that. Take listed investment trusts, for example. 7 years ago, there were 0 investment trusts listed in India. Today, there are 29. And this number is only going to grow. And if you look at the returns that listed investment trusts as an asset class have delivered, they are clearly capturing equity-like returns. There is an equity feature to the underlying risk, right? Similarly, when we talk about private credit, which is a part of alternatives, private credit in India is really small today, right? It's less than 1% of the GDP. In India, we tend to often compare things with what's happening in the US. In the US, private credit is 6 to 7% of GDP, but private credit is growing at 2x the rate of bank credit. And why is private credit growing? Private credit is growing because there is a demand for flexible financing, yes, which is no longer met by banks, right? We are big investors in banks. We know what's happening inside banks. And there are certain classes of risk. Take BBB, for example. Take infrastructure under creation, for example, which banks are redacting, right? So banks are moving away from BBB. BBB by nature needs flexible financing. And that flexible financing is coming from private credit. And what private credit does in return, it extracts an equity optionality and therefore can deliver an equity, not equity return, equity-like return. Of course, private credit is available only to accredited investors. There is a market failure in private sector fund of funds. I hope, and I'm sure that will be addressed soon. So the average investor might be able to access private credit through private sector fund of funds. But taking a step back, broadly speaking, the innovation in credit, private credit, listed investment trusts, is helping investors capture equity-like returns with the benefits of fixed income.
Well said, and I think we thank you for that, and thanks so much, gentlemen and lady, for joining in on this panel. Appreciate it.
India Bonds presents CNBC TV 18, India's Fixed Income Summit.